So hey everyone, this is Finance Meets Real Estate. As you guys know, we meet here every Tuesday, 6:30 p.m. Eastern Standard Time. We get many different guests every week, or different guests every week. We have Jack McGinness here today. And so he's going to talk about making multifamily deals work at the current interest rates. It's it's been interest rates did come up down a little bit, but it's been a challenge for everyone. Getting their deals done and having cash flowing deals in the current environment. So Jack, he used to be with Lima One Capital before. That's where I met him first, actually. But he's now at Bellwether Enterprise, and he does agency debt and other debt for multifamily and commercial real estate. And so he's had a career in lending, and he earned his bachelor's in finance from Terry School of Business at the University of Georgia. So with that, I'm gonna pass it on to Jack. Whenever you get your screen share, we can also we can also just converse as well.
Yeah, and are y'all seeing it on y'all's end?
I do, yeah. That's good. That's good. If you want to make it full screen, basically, I think even better. But
there we go. Awesome. So y'all are everyone's seeing it?
It's good. It's good.
Okay. Awesome. Well, yeah. Well, great to get this opportunity. I sure appreciate it, and excited to. I guess we'll do some questions after this. So excited to connect with everyone. And yeah, I guess I'll just jump right into it if no one has any initial questions.
Yeah, go ahead. Yeah, we will take. Okay. We can take Q&A at the end. We will do 15 minutes at the end, whenever you're done.
Okay.
All right. Thank you.
Yeah. Well. So yeah, this is kind of just going to be more broad. Just a lot of general trends and just kind of key things to think about. And then I was thinking when we get into the questions, if we want to get into the specifics on anything, we can certainly do so. But wanted to kind of hit on some of the key trends we're seeing, and things for investors to consider that's kind of unique to this current moment. So anyways, so yeah, obviously everyone knows we're dealing with a rising rate environment, and that makes things kind of challenging across the board, and certainly in commercial real estate. So what I'll plan on kind of going through is do kind of a general rundown on just the state of the capital markets and what debt options are out there, and then kind of what the kind of main food groups, so to speak, are for financing multifamily investments, and then going to really focus in on bridge debt versus perm debt, particularly in this current moment, and when each makes more sense and which is best, and then kind of talk about just what does it look like to qualify, what are lenders looking for on any given deal.
And just Jack, just to hold you there, just a quick question, so where are you seeing bridge, let's say, as of today, in terms of I don't know, in terms of interest rates, what is the lowest rate people can get, I guess, relative to prime rate? Is it 8-9% the lowest one, or is it more 10-11, just for our audience?
Yeah, so it's obviously going to be specific to the deal, but yeah, we're starting to see it go up into the double digits, but there's also some bridge lenders that are still in the mid sevens on rate. So it really is deal specific, and also probably more so the amount of leverage. So and if it's there's bridge lenders out there that will do 85 to 90% loan to cost on both the acquisition and all of the capital expenditures, but that's kind of your more high octane bridge loan that, these days is probably 10 to 12% on rate, whereas, we've seen a lot of, say, life insurance companies, for instance, that are providing bridge debt for stabilized properties. It's just kind of going to allow you to bridge the gap into permanent financing once rates have potentially come down a bit, and then kind of everything in between. So we'll kind of get more into that, but so anyways, but it's kind of pretty big variance there.
Mhm.
But yeah, and then just to kind of, like I said, we'll go through also what lenders are looking for, and what it would take to kind of qualify a particular deal, and then obviously go through questions. So just a quick rundown on the state of the debt markets and what kind of financing options you have right now. It obviously, with rising rates, it makes everything more challenging to get deals done, to make the numbers work. Obviously, when you've got interest rates that were 3.5%, give or take, say, on a permanent loan for a multifamily property 12 months ago, and now that's double. But cap rates haven't really moved. That definitely presents a bit of a challenging environment, and it just makes it that much more important that you're selective on the deals you chase. This also obviously impacts the lender's cost of capital, and so the the banks, for instance, they're having to deal with their own capital becoming more expensive at the same time as your average Joe who's got all their savings in a bank is now pulling out some of those savings, just with inflationary pressures and whatnot, and so that kind of creates a challenge of its own. And so because of that, banks are more selective. They're doing less deals, and and that kind of trickles down to other lenders as well. And then another thing that is kind of going on, that is maybe, I don't know if it gets talked about as much, but as yields have gone up, just for, say, like a T-bill, for instance, like if you can get a safe bond now at 3.5% yield, and a more risky commercial real estate asset, cap rates haven't really moved. It's not much higher than that. Now all of a sudden, like, if you're
Hey.
thinking,
So
I'm sorry, was someone
Go
saying
ahead.
something?
Sorry, Alex, go ahead. You have a question, actually? Looks like.
I apologize. I didn't want you to lose your train of thought, but I was following along. Capital, you were saying capital. Can you kind of tell me what capital means? I'm sorry.
Yeah, no, all good. And no, there's no silly questions or anything here. So, ask away. But yeah, that would just be, just, I guess, any kind of financing for, in this case, for your real estate investments. So just think cash, and that could, whether that's US dollars or foreign monies coming into the US economy and into the real estate market.
Okay, awesome. Thank you so much. Sorry again.
Yeah. So yeah, anyways, the kind of, I guess, one thing that has also been kind of going on, I won't get too far into this, but is the like one example I've heard people talk about is if you think about how some of the bigger institutional investors have gotten into, say, like the SFR space and built for rent projects, a lot of that came out of wanting to, that's going to give you a good yield in a 12 months ago when it was really tough. I mean, you had multifamily properties that had a 3% cap rate, and so, but now you can get a, secure bond for that, a similar yield where, and that theoretical commercial real estate asset hasn't moved. So, you're seeing how that might start to impact the commercial real estate market as well. So, and there's obviously all kinds of other, trickle down effects, but kind of want to just hit a couple of these just to kind of give as an example, to really kind of illustrate the bigger point, which is that not only does the rising rate environment just make deals tougher from a, just strictly getting the numbers to pencil out, but it's also leading to, credit tightening, and it's harder. There's just less money out there for investors, and they're, instead of, say, 12 months ago when you had just seemed like just about anyone could go, walk around the corner to the nearest bank and get a loan to buy a apartment, for instance. Kind of the pendulum has completely swung the other way. And so, you've seen the Fed has also increased the reserve requirements for the big banks, and that's going to trickle down to your smaller local banks, to other capital sources for financing real estate. And so it just means there's just less money out there, and so they're that much more selective. And then also with just kind of the uncertainty.
Jack, just to confirm, like, do you I'm just, are we looking at like a particular slide, just making sure, or
are y'all seeing the
because I'm seeing only the main slide, like the initial one.
oh, okay. Yeah, let me, I think I had the wrong. What about now?
Oh, it's still the same. It's still the same, actually. You wanna try resharing or something like that?
Yeah, let me I'm gonna,
Yeah, sure. Yeah. In the meantime, if you guys have any questions, I see like some questions already on the chat. So if you guys have any, any other questions, feel free to put them there, or also speak up. So we will, if you put your questions on the chat, I will just relate them at the end. So we can do this way. I think rates volatility has been another, perhaps you have it on your slides, like another, simply the volatility itself making some of the deals fall through for some investors. And so besides the credit tightening and just that the rate is higher, it's just the fact that the lack of rate locking, essentially.
all right. Sorry here. I don't know what happened here. So, and was it it was just showing the first page of the presentation?
Yeah, exactly. I think if you, I mean, yeah, I know, let's just try to reshare it. That's all. I'm sure it's, yeah.
Oh. All right. What
Yeah,
about now?
we do see it now. So it's on slide 5.
Okay, awesome.
So
Well,
we see it, right. Do you want to quickly go through the previous ones, just kind of show what?
yeah. And all right. So, okay. All right. So we kind of hit on the state of the capital markets and credit tightening.
Mhm.
And is it showing? So y'all are seeing the full slide now? Just
Yeah. No, it's
okay.
perfect. Perfect.
All right. So so yeah, that basically you've got on for one, lenders becoming more selective, more skittish, and then on top of that, reduce leverage. So I one thing I hear people say, 60% is the new 75% is as far as a deal that maybe could get 75% LTV. Now you're looking to you're lucky if you can get 60-65%. And I'll kind of go through why, but obviously as rates go up, it just makes it harder for properties to debt service. And across the board, what we're seeing is that if you think about like the capital stack on any given deal, the senior debt position is shrinking essentially. So if, a typical deal was maybe 70% for your senior debt, and then maybe smaller deals, so the borrower covered the remaining 30%, or say it was a $50 million deal and that 30% was maybe 10% of it was coming from the borrower's equity, another 20 from say like mezz debt or something like that. Now you're starting to see that be now you got say 40 to 50% that you've still got to cover after that first position senior debt. And so that presents some challenges there. And this is occurring because you've got some lenders who their absolute max loan amounts have lowered. So if they normally would go up to 75% LTV, now just across the board say they won't go up to the max they'll go is 65%. But where you really see this starting to occur in the cause is more with regards to just making sure the deals still can debt service. So most lenders have anywhere from 1 point seen as low as like 1.15 to 1.5, but typically somewhere between 1.2 to 1.3 for their debt service coverage ratio requirement. And obviously that gets challenging, say if you're buying a property that has a lower cap rate than the interest rate. And so you've got to really reduce total loan proceeds. And then that also has an impact on investors, folks who are trying to essentially kind of recoup your sweat equity into a deal. So let's say you bought a property with cash, and you wanted to, and you bought it at a discount. So, if you bought it for, say, it's $1 million property that you bought for 800 grand, and you wanted to turn around and refinance based on the $1 million valuation, and kind of recoup the 200K that you put into it, that's becoming a lot more challenging. And I'll get more into the kind of nuances there, but basically a lot of lenders are also starting to increase their seasoning requirements, and seeing a lot of lenders that have maybe historically been able to do to assess a deal based on value as opposed to strictly cost. They're still going on a more of an LTC valuation, that including sometimes even something like a construction takeout. So I'll get into use kind of an example scenario here, but just another thing to kind of keep in mind. So now we kind of covered that. Just wanted to quickly go through your kind of main debt options for multifamily, and this probably not stating anything new to anyone here, but obviously you got, agency debt, bank debt, life insurance companies, and then debt funds, bridge lenders, private lenders. Those, there's other options, but this is kind of, I guess, the core different types of financing options for multifamily. With agency and life insurance company debt being your lowest cost of capital, and debt funds, bridge lenders, private lenders the highest, but also having the highest risk tolerance, and will do the highest amount of leverage. And so kind of within that, when you're looking to finance any kind of multifamily acquisition, you're really looking at bridge debt, which would just be short-term financing, anywhere typically from like 12 to 36 months. Seen some bridge loans that will go all the way out to 5 years. They're typically interest only. And then, perm debt is going to be your lower cost of capital, more secure financing would be a way to, I guess, to kind of think of it. So, again, or to kind of hammer down the differences of the two, with bridge debt, it is going to be more expensive, but you're going to get more leverage, and you're going to be able to close quicker. And then that bridge lenders tend to have more risk tolerance, so they kind of have a bigger box as far as what will and will not qualify. Conversely, perm debt options tend to be lower cost of capital, but also lower leverage, a little bit more underwriting intensive, and a bit more narrow of a box, and and that doesn't mean that they won't be flexible, but if you're buying, say, a 50-unit apartment that's 20 of the units are completely run down, you're not, you're probably going to need to use a bridge loan to kind of bridge the gap and get that property stabilized before you can convert it into permanent financing. And we'll be getting more into that here, and where that might relate to kind of this current moment in what's going on in the market. And so which of these is best? Well, it's obviously going to depend on the deal, and the state of the market. Today's market environment I would say makes bridge debt more attractive than ever, because, if you think about it, maybe one most obvious is you can, plan to refinance into a better day. So if you think that rates are maybe going to go up a little bit more, but then they're going to come back down, and then it might make sense to, even if you're buying a multifamily property that's completely stabilized and performing, and it would qualify for, say, like an agency perm loan, maybe it makes sense to still use a bridge loan, in the hopes that, say 2 years from now, you could refinance into a perm loan that's 150 basis points less than what you would be able to qualify for today, with a permanent financing. It also allows you, with bridge lenders having a bigger box, so to speak, more risk tolerance. it allows you to acquire a deal that might have some hair on it, which especially right now when there's just not as much money chasing these deals, it and thus not, the hairier deals have less demand. It allows you to buy a deal that maybe has a little bit of hair on it for cents on the dollar. And with it being tough as ever right now to find those deals that have upside, given the rising rate environment and cap rates staying fairly stable at this point, it it this is that much more advantageous, basically. And so the well, I'm pulling up a chat.
Just to quote you there. So isn't that kind of a view on interest rates that they would decline in that case? If, is that what you're seeing in the market, like in terms of investors viewing bridge as more attractive right now?
Yeah, it's definitely the case. And in fact, we've even seen a lot of, kind of to your initial question about where bridge debt, kind of where it's priced, where rates are. We've been seeing a lot of, the like life insurance companies and banks, and just a lot of, your more traditional permanent financing lenders have started to roll out, like 3, even 5-year interest only bridge loans for that very point, is basically to just give an investor the chance to refinance, when assuming rates come down, even if it's a deal that wouldn't otherwise be a candidate for a bridge loan.
Yeah, understood.
and
Understood. So, Jack, just so basically, it's kind of an argument on prepayment penalties in permanent financing. Sounds like.
right, yeah,
Yeah, it's just.
yeah, and we definitely plan on getting into that, but yeah, that's definitely something that I think is super important right now, more than ever. If to anyone out there who is has a deal they're looking to acquire or just working on, and if you are consider or even refinancing a deal, is if you're considering any kind of permanent loan, it's definitely worth the extra 20 to 40 basis points on rate, to reduce your prepayment penalty, so that you have that kind of flexibility to in the event that rates come back down. All right, well, I'm going to keep moving on here. So anyways, I think it's important to kind of hit on, and I think this will help make sense of some of what I've brought up before, but to kind of hit on, how do you qualify? What are lenders looking for when they're, underwriting any given deal? And, I would say kind of good just little axiom would be, at the end of the day, cash flow on the collateral itself is king when it comes to, multifamily financing. That, that's not to say that, you as the borrower and your financials and experience isn't important. It certainly is, but or even the global cash flows across your other assets. But at the end of the day, the way that a lender is going to look at this is, okay, does this particular property generate enough income to, after expenses, to cover our note? And then kind of what that looks like, though, is where we'll get into some of the differences between different lenders, and particularly bridge loans versus permanent loans. So like I said, sponsor quality, global cash flows, liquidity, all that matters, but it's not as important as the property that's serving as the collateral, uh, being able to service the debt itself. And kind of preface all that because obviously with rates going up, it becomes that much more of a challenge to service these loans if you haven't, if that same property, for instance, rents haven't gone up and pricing hadn't come down, which is effectively kind of where we're at this current moment. And so how do you navigate in the face of that, and how do you make these deals pencil out? Well, this is where I kind of want to, get into some things to consider and related to bridge debt versus permanent debt is, you know, a perm loan, and the way that lender will underwrite it is basically they're thinking, all right, this property we're lending against, it's it's stabilized, turnkey. What you see is what you get, kind of, essentially. And so they're going to want to see that it has strong in place debt service coverage ratio and can service that debt from day one. So, if you buy a property and rents are 30% below market and they've got expenses that are, a bunch of unnecessary expenses, that's great, a lot of upside. But if you're trying to get a permanent loan for that, that's not going to matter. They're going to want to see, okay, well, that's great, but what about right now? How has it performed the last 3 to 12 months, and what are the financials of the asset look like today? And so obviously, not to sound like a broken record, but what is it? How do you navigate that when you've got a situation where cap rates have stayed fairly stable, but interest rates have almost, doubled? And like you take just your typical primary market and, still see, cap rates in like the 4% range. But if you were to get a permanent loan on that theoretical asset, it's going to be probably in the 6% range. And so you're really looking at pretty low leverage to then have a 1.2 to 1.3 debt service coverage ratio. So this is where the kind of bridge debt becomes pretty appealing, and particularly a bridge to perm financing arrangement. So this is great for deals that have a lot of upside. It does require multiple transactions, which comes at a cost, meaning, you're looking at using a bridge loan to fund the acquisition and potentially rehab capital expenditures if applicable, and then basically use that time to drive up NOI as high as possible, and get your rents up, get expenses under control, and then once that property stabilized, you can convert it into a permanent loan, and now you've got all kinds of upside there. So to kind of use an example, if you had, say, a 50-unit distressed multifamily property in Nashville, and if you were buying that 50-unit and it was stabilized with a permanent loan, and let's say the market trades at a 5 cap, you're still buying it at that 5 cap, and thus kind of paying a premium, but you're no longer securing that with a loan at 3.5%, but say 6.5%. And now you're looking at having to come up with 40 to 50% as your down payment, because your leverage is going to be very constrained in that scenario. Conversely, though, if, let's say you were to buy instead of 50 unit distressed property, well, now you're looking at being able to buy it at a steep discount. And that's not just the, cost of additional repairs that it's discounted by, but, those are less attractive deals. There's less demand for it. And so, you can buy that for cents on the dollar as opposed to 120 cents on the dollar or something like that. And what this will allow you to do is you would basically use a bridge loan to fund the acquisition and rehab. And that is going to come at a, higher cost of capital. We kind of mentioned it earlier, but, it's not, if you're looking at a more, higher octane bridge loan, that's higher leverage, you're also looking at probably, 10 to 12, even 13% on your interest rate. But, you're not having to give up equity or come out of pocket with much. You're looking at, from the outset getting, typically 75 to 85% loan to cost, which would be, say 80% of the total between the acquisition and all of your capital expenditures. So instead of coming out of pocket with, 40 to 50%, you're only having to come out of pocket with, 15 to 25%. And then once you've gotten that property stabilized, you've really driven up the NOI as high as possible. Now you can start looking at refinancing into permanent debt. And that alone would be an upside because you're now going to be able to refinance based on the new valuation of after increasing that NOI. And let's assume that cap rates stay at this, theoretical 5%. So you really, you might be able to recoup all of that 20 to 30% of that you put down. And then on top of all that, you're looking at the possibility of also refinancing into a more favorable interest rate environment. And so, that kind of adds one more additional benefit there. So we can kind of talk through if y'all have kind of example deals yourselves. I wanted to conclude by just briefly hitting on, we've been talking about refinancing into a lower rate environment. And so I wanted to quickly hit on, what does the future environment look like, 24 months from now? Well, in short, no one really knows. I think, it's could be anyone's guess. It does seem like all indicators point to rates continuing to increase in the near term. I saw yesterday, basically the, I guess it was the New York Fed president and St. Louis Fed president, basically said, well, quote, we have to avoid that temptation here and really stay with restrictive level of the policy rate longer in order to be sure that we're pushing inflation back to the 2% target. So basically, even though things are starting to seem like inflation's coming down, they've indicated they're not going to let up on continuing to raise rates. I think, a lot of people are thinking instead of 75 basis points, there'll be a 50 basis point hike in December. But that's kind of where, reading the tea leaves, so to speak, that's kind of what things look like in the near term. In the long term, I think maybe a better strategy as an investor would be, instead of worrying about that, which none of us really know, think about how can you adapt and approach scaling your business without kind of agnostic to what happens with interest rates. And so that means having the flexibility in the event rates come down for early loan payoffs, or maybe you makes more sense to sell the property, and entertain using shorter term bridge loans for any current acquisitions when that makes sense. And then I think the main thing, we didn't really hit on this too much, but and probably a topic in and of itself, but I think it's also important, and you're kind of seeing this already starting to play out, but to really focus on the fundamentals and economics of the specific locale, the specific market you're investing in, as opposed to the overall kind of macroeconomic factors of the overall market as a whole. Just because it is, it should be kind of apparent if you had say a smaller secondary market that maybe historically hasn't been as appealing as a primary market for commercial real estate. Well, if that market is experiencing a population boom and job growth, and then conversely, primary market that was considered kind of the top tier market, so it's priced higher. If that market is seeing population, a declining population and job growth, then no matter what's going on at large, it would, one would intuit that the first market's is a good investment, and the second maybe not so much. So and I think there's all kinds of different things like that you can really think through and use as a framework for kind of navigating things, that regardless of where rates move. I mean, that obviously is going to have indirect effects no matter what, but it allows you to kind of be a little bit immune from it. So anyways, yeah, I think but that's pretty much it. I wanted to leave some time for questions, and I saw some come up in the chat.
Great. Yeah, thanks, Jack. That was great. So yes, I can relate some of the questions actually there. So like, so Sean is asking, so how to buy my first rental multifamily unit? I paid off my current home without any mortgage. I have saving but no W2 or monthly income. Credit score 800 plus, no other debts. Is there any creative way to fund or use other people's money to buy it?
Yeah, great question. So and really, this is this is a question I hear a lot, and there's really a ton of options here. So a lot of folks who are maybe newer getting into investing in real estate, who've maybe gone through the process of buying their own primary residence, and then want to pick up a rental property like this. The way that a lender will assess an investment property versus someone's primary residence can be very different. And so in particular, if you're trying to get a loan for your primary, it's all about your personal debt to income ratio, and so you got to have W2 and be able to show that monthly income. For an investment property, though, it's all about, kind of like I mentioned earlier, cash flow is king when it comes. All they're concerned about primarily is as far as whether or not you can or cannot service the debt. It's all about the asset, not the individual. So in this case, does this rental property generate enough rental income that there's plenty of coverage to pay that, to make that monthly payment and service the debt? And so, here, and I can kind of even refer you to some folks, but there's all kinds of asset-based lenders, even for SFR rental properties, they're going to not be too concerned with your personal debt to income or anything. They will want to make sure you're credit worthy, and that you kind of have you know what you're doing, like you got a track record and or a good plan in place, and then and you've got enough cash to have your own skin in the game, basically, to cover the down payment. But otherwise, it's all about the asset.
Yeah, if I may add, like actually, Jack, like just kind of in my experience, I guess. Yeah, so in that way, yeah, I would say indeed for 800 plus credit score, no W2, it's kind of very much the game of asset-based lenders, right? Assuming, I'm not sure, assuming they're talking about not commercial, right? That they may be, I'm not sure in the commercial space, absolutely different, but yeah, in the event they're speaking of 1 to 4 unit, I'm not sure what Chun means there, but yeah, it's definitely a very much asset-based lenders. They want a good credit score and they don't need a W2. So that's kind of, and there's also creative financing, I guess, like seller financing. So the seller of the property may be willing to finance it for you as well.
Yeah. Oh yeah, absolutely. There's, that's one thing we didn't really hit on here. But definitely, especially, there's all kinds of ways you can get really creative with it too, whether it's like you mentioned with seller financing, or if it's a smaller deal like that, there's some kind of creative outlets. But I guess another situation topic in and of itself. But yeah, no, happy to, I think I've got my email here, so if you want to reach out with anything in particular, happy to discuss that as well.
Sure. Yeah,
Offline.
sounds great. Sounds great. So another question actually we have on the chat. So Richard is asking how practical or doable is trying to assume commercial or multifamily properties with lower rate debt from different types of lenders, and this is a second loan allowable ever?
Yeah. So we had a call with a representative from Freddie Mac. It was maybe 2 months ago now, but kind of to this question, they had said that they had assumed more loans. Can't remember if it was that quarter or like year to date than ever. So, because if you have that option there, that if you can assume a 4.25% loan, when if you were to instead buy it and secure a new financing and you're at 6.5%, then that's obviously a no-brainer. A second, when you say a second loan allow, you mean like a subordinate debt? Like a second position?
I guess it does sound like it does sound like a second position to me.
Yeah. So yeah, absolutely. It's going to vary lender by lender. It's not very common. I would just say, kind of in general, it's not very common if you're talking about smaller loans. Certainly loans under $1-2 million, really more, even all the way up to like 10 for any kind of typically you don't see a lot of second position debt. You might see pref equity, or just raising additional equity from LPs or syndication, something like that. There's definitely all kinds of ways you can get into a deal that, let's say you're going to buy a $5 million property and you can get 65% leverage for the first position. So now you've got a $3 million loan, you got $2 million you got to come up with. There's all kinds of ways you can make that, come up with that $2 million dollars. But the main thing typically is you're going to need to have someone, one of the key sponsors, and the main members on the deal. They're going to need to have the personal financials to kind of support that, like meaning net worth and liquidity. But then you could raise the rest of that money just from a lot of different limited partners or preferred equity or something like that.
Right. And just so, but I guess, so there's the biggest number of loans, let's say assumed, let's say ever, like, or like relative to other periods, which kind of makes sense. It's just more people wouldn't even exercise this option before, right? They wouldn't care. But
Yeah.
now in terms of from the lender's perspective, like what percentage of lenders you think would be okay with that? Because I mean, they would otherwise sort of be consistent with where the current market rate is. Like why would they agree to assume a loan, or the loan to be assumed, so to say, rather than just issue a new loan at the current interest rates? What percentage of them would agree to that? I wonder, in your experience.
That's a great question. And this is kind of where the whole idea of prepayment penalties comes into play. But if you think about, I guess, in general, when a lender makes a loan, whether they're holding that paper on their long term on their balance sheet, or it's essentially it's eventually part of a securitization or whatnot, they're making that loan under the expectation of basically getting expected future payments. And so if you thought about it, so the present value of that loan is essentially the discounted rate of return of those expected payments, and then the eventual payoff, just like a bond or any other kind of fixed income asset. And so one kind of risk of that is if it gets paid off early, instead of you getting, let's say, a 5 years of payments, you only get 2. Well, then the present value of that loan is less, and so that's why you have yield maintenance or prepayment penalties in place. And so I'd say first off that's partly why is even though it might make sense that well, why would a lender want to keep a loan at 4% when they could refinance it and now do so at 6%? There's that's part of it is just where those expected payments are, and then well, where was the value then versus now? And then also a lot of most lenders are not keeping these loans on their balance sheets anyways, and so they're essentially selling it, and so it's kind of I guess I wouldn't say irrelevant, that's not the right word, but they offloaded that loan with out of essentially a value based on certain time frame of expected future payments. And so if you refinance that, you're kind of you'd want to have a prepay to offset it. So it's not always, I guess,
So,
I wouldn't say profitable, but I think that's kind of part of what's going on there. But it's a really good question. I haven't really thought about it.
so if it's, so it sounds like more assumptions are happening perhaps where the old loan is relatively recent, such as let's say 2 years old or something like that. Is that the case?
Exactly.
Rather than if it's, let's say, 5 or 10, where basically very few assumptions would be happening, sounds like.
Yeah.
Have any of the, they would be all fine with regards to the present value of their future payments or whatever. They just made the money that they wanted to make, basically.
Yeah, exactly. And it's also, if you think about it, it's in the seller's best interest as well, because if the seller, say, they bought a property 2 years ago and they got a 70% loan at a 4% interest rate, but with a really steep prepayment penalty. If they were to sell that and the buyer assumes the loan, then they also avoid the prepayment penalty, and that buyer is also assuming a loan at 4% as opposed to 6.5%. And they would, because that would trigger the seller to have to make a prepayment penalty. They might want to negotiate with the buyer, like, hey, this is tens of thousands of dollars more expensive now that we have to make this prepayment penalty. So then they want to renegotiate that purchase price, for instance. So it's definitely the incentives for both the buyer and seller are to assume a loan if it's possible and makes sense. And then and from the lender's standpoint, that was a really good question. A little bit, there's a lot of moving parts there, a little bit tricky, but I'd say it's maybe a net neutral for the lender, as long as they're going to get their prepayment penalty, or if it gets paid off early.
Okay, understood. So another question. So how do you get debt from insurance to buy a property? Or I guess from life insurance companies?
Oh, from life insurance. Yeah. So that's where you would come to me. But no, you would do that through a commercial mortgage bank. So like BW, we have correspondent relationships with life insurance companies throughout the country, ranging from really small kind of niche life insurance company lenders that will do the biggest loan amount they'll do is say 5 million, all the way. And then we have kind of on the other end of the spectrum, we have life insurance correspondent relationship with life insurance company lenders that won't even look at a deal under 50 million, say. And so that there's kind of options, across all different types of deals. The main thing is they typically are life co-lenders are going to be, that might be the lowest cost of capital, but they're also going to be the lowest leverage, and typically don't have call it a retail facing channel. So if you wanted to see what kind of loan, like explore financing a multifamily property with Northwestern Mutual, say, they don't have, you would actually do that through a commercial mortgage bank that has a correspondent agreement in place with Northwestern Mutual, for instance.
Okay. Yeah, that's great. So just I got like a couple of questions actually. Just can you make sure just to share once again your contact information, Jack?
Yeah, let me
And I
type it
think
in the
Yeah.
chat here.
I think that should be a good time for, yeah, we're pretty much at our time, like with the delay, so,
Yeah, and
yeah.
I'll will there be a list of all the attendees here?
Yeah, let's connect after this. Yeah, let's
Okay,
connect.
okay, yeah. Okay. Did I actually? I think I don't.
I think it was on the
Did you
last
see
slide,
the
perhaps? Was it
my
on the
email
last
come in?
slide, or do you have it perhaps on the last slide of the presentation, or?
Oh, I do. Oh, I didn't realize I hadn't
Yeah,
put it
yeah,
on the. There we go.
yeah,
There we
sure.
go.
Yeah,
There we go.
exactly. Okay, no worries. Okay, yeah, so jack.mcginness@pwa.com.
Yeah, and
Okay.
I just realized I didn't reply to everyone. I type it in the chat along with my.
Sure,
I'm
sounds
gonna
good.
go ahead and share my personal cell.
Great. So that was really great. Thank you so much, Jack. I learned a lot, and with
Yeah.
regards to COO financing, I think it's a very hot topic right now, and all the other questions that we covered. So appreciate coming on here today. Thanks to everyone else for joining us here tonight, and have a good night.
Yeah.
Thank you, Jack.
Thanks.
Good
Thanks, everyone.
presentation. Thank you.